So something you might see in this chapter that's different than what you've seen before is a multiple step or a multi-step income statement, which is really just like an income statement, which you have seen before, but with much more detail, and it's broken into multiple steps, I guess you would say. So you'll see it starts with sales at the top, but then there'll be less any sales discounts and less sales returns and allowances, which we learned is when we're the seller, any discounts or returns and allowances we offer. Our sales minus our sales returns and allowances, our sales discounts and returns and allowances is our net sales. Then we subtract our cost of goods sold, which gives us our gross profit. So that's pretty different than income statements we worked with before for service-based companies. Remember, gross profit is sometimes called your profit before operating expenses or your profit before fixed expenses. So then expenses are broken down into multiple categories. So we have operating expenses, which are broken usually into selling expenses and general and administrative expenses. And then our gross profit minus our operating expenses, minus our general and admin expenses gives us our income from operations, or sometimes it's called operating income. And then other revenues and expenses are also listed. These would be revenues we make from areas that aren't part of our normal day-to-day business. So this business earned interest revenue, probably by having some of its money invested. They gained on selling a building. Again, they're not in the business of selling buildings all the time, so they don't want to list that as part of their sales revenue. And then they had an interest expense of $1,500. So that's their other revenues and expenses. And so our operating income plus or minus our other revenues and expenses, depending on if we had more revenues or expenses, gives us our net income. So that's a multi-step income statement, and you'll see those starting in this chapter. And then also there's what's called a classified balance sheet. So this is just the current assets section, but the classified balance sheet will split assets into current assets, sometimes called short-term assets, and then long-term assets, often called property, plant, and equipment. And so current assets are those assets which are liquid, meaning they're either cash or readily convertible into cash, or something that's consumable, something we'll use up within the next year, usually to be included in current assets. So you'll see in the current assets section, you have cash, accounts receivable, merchandise inventory, office supplies, store supplies, prepaid insurance, etc. Typically, they're listed in what's called liquidity order. So cash is the most liquid of all assets because it's already cash, down to like prepaid insurance, which is less so. You can't really do much with it except wait for it to expire by having the insurance coverage. The next category after this would usually be called property, plant, and equipment, which would include things like land, buildings, equipment, etc. You'll also see the liabilities broken into two categories. One are current liabilities, which are liabilities that are due within the next year, and long-term liabilities that are due in a year or more. So those are the two, I guess, changes you'll see to the financial statements starting in this chapter.